Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about a word you probably hear all the time in the investing world: diversification. My favorite investor, Warren Buffett, has a very, very famous quote: diversification is protection against ignorance. That's all it is. If you know how to invest, you don't diversify any more than somebody who's an entrepreneur would think it's better and lower risk to have 100 businesses going on at the same time than to focus on one really good one. Now, we are going to diversify a little bit, just naturally the way it works as an investor. You're going to end up with 5 to 10 companies probably. But most people will trust a financial professional who's spreading their money across every flippin' investment they can find. They're doing cash, bonds, real estate, commodities, 300 different stock funds. But all of that is really considered by good investors to just be massively over diversifying. And it isn't helping you. At best, you might break even with the markets that each one of those things are in. So in order to generate consistent returns and you make a lot more money, it's a lot better to take this Rule 1 approach. It's been working great for 85 years. You go out and you find businesses you understand and believe in, and you really get to understand those businesses and make sure that they have a big moat and that you can buy them being run by great managers. You can buy them on sale, okay? Now, sure, you're going to diversify your portfolio a little bit. You're going to invest maybe 3 to 5 different businesses. Charlie Munger likes 3 businesses. Warren Buffett, 5 to 10. I like 10 for people who are just getting started. But you're not going to end up with them all at once, right? Not unless the market just crashes and puts everything on sale. Generally, you're going to step in and put money into one at a time and gradually build a portfolio that has a small number of businesses you really like. Warren Buffett has about 70% of his money in 6 businesses. And that hardly counts as diversification according to the standard of the industry, where they think diversification is, 4 different exchange traded funds, each of which has 200 stocks in them. So here's some quick tips for looking that you could be looking for when you're going to invest on your own. First, I like to think about getting very focused on one area of the market. Get it inch wide and a mile deep. That's what we like to think about, where you can really find companies that match your values and just wait patiently to buy them on sale. It's really better to buy one really right thing over and over again than many, many wrong things one at a time. We want to buy great companies. By the way, I'll tell you a quick story. A couple years ago, Warren Buffett, the market was kind of headed down. People were nervous. Warren Buffett, this is I think 2008, Warren Buffett was asked, aren't you upset that this market's going down, right? All these stocks are going down like crazy. He said, no, I want to buy more of them as it goes down. When you know what you own and you know it's a good business, a down market's a wonderful time to invest. When you have diversified across hundreds of things you don't know anything about, a down market is a nightmare. You don't know how long it's going to take before it comes back and you break even. Last time, about 10 to 12 years. So we don't want to do that to our portfolio. Now, here's where risk comes from. This is a key thing to understand. These professionals tell you to diversify to protect yourself from risk, okay? And granted, if you don't know anything, you got to diversify because you don't know whether you're buying a good thing or a bad thing. In other words, risk really comes from not knowing anything about the business, not knowing the value of the business, and not understanding the business. Imagine if you're going to take a car and drive down to work. It's no big deal. You're driving, you've done it a million times. You're going to get there safely, okay? Take the same journey, same vehicle, same goal, same everything, but have your 12-year-old nephew drive you, then you're not going to get there at all, probably, okay? So the journey's the same, the vehicle's the same. It's about the education and knowledge of the person driving the car. Buying $10 bills for $5 is what we're out to do. That's what we think of as when we're buying companies that are on half price. So we're going to buy a $100 company for $50. We're going to buy a $10 bill for $5. That's the nature of the game. So what we're going to understand is if you can do that, you're going to do it when those rare opportunities come along, and then just let diversification happen naturally. You're going to buy that wonderful business. When it starts to go back up, you're not going to buy any more of it. You're going to look for the next opportunity. After 20 years, you might own maybe 20 total companies. So the bottom line is find a few great businesses that you are knowledgeable about that you can buy on sale and learn how to invest with rule number 1. Now, I'd like to hear from you guys. Have you ever had funds that over-diversified and did not deliver a riskless portfolio anyway? They still went down when the market went down. And how about those of you who didn't anywhere near get the returns you were hoping for? Leave a comment below, and I'll be sure to follow up with you. Really appreciate you watching. Now go play. And if you enjoyed this video and you think it was valuable for teaching you more about ruling your financial future, then here's what I'd like you to do. Please subscribe to this channel, like this video, and share it with your friends or anybody else that might benefit from this information.